warm welcome to this ET Now special. I'm Supriya, Shrinate, and over the next 30 minutes we're going to talk not just about policy, which is status quo by the RBI, but we're also going to talk about the assertion of independence, autonomy, and of course authority by the RBI, because all MPC members unanimously rejected the request from Finance Ministry to meet North Block officials, because many people would have taken this as a sign of influencing their verdict, influencing their judgment. So that's very heartening. And what is also heartening is that this isn't a unanimous policy decision. There's been a dissent, and which is why the MPC was in any case constituted, to bring in more diverse views. So over the next 30 minutes we're going to debate that apart from the policy action with a very, very eminent panel here. So thank you each one of you for being with us. And Mythili, let's begin with talking to you about what the governor said. The question asked was very direct. The MPC members were asked to meet the Finance Ministry. However wrong it was for the Finance Ministry to ask that, the MPC members unanimously declined that request. What does it tell you at this stage? Is there a new front that has been opened between the RBI on one stance and the government on the other?
As for opening another front between the government and the RBI, remember the equation has now changed. It's not between government and RBI as much as between government and MPC. And that in fact was the whole purpose of moving to an MPC regime. Because unlike earlier, when all you had to do was a finance minister or somebody in the finance ministry, the secretary for instance may be picking up the phone and speaking or summoning the governor to Delhi, today you have to speak to 6 separate MPC members. So that is what has made the difference. So today it is no longer RBI versus government, but if you can talk about it versus, frankly it shouldn't be versus. You and I could have different points of view because our perspectives are different. Governments always look at the short term, MPs look at the long term. So there's bound to be some kind of a discord, as it were, and it's there across the world between governments and monetary policy authorities. So to my mind, it's not so much a front between the RBI and the government as a disagreement between the government and the MPC. And to the extent that you now have an MPC, to that extent the MPC is insulated from government pressure. And that to my mind shows a welcome maturing of a new institution. It's a very new institution, and I think kudos to all the MPC members for standing their ground against, I'm very sure, must have been pretty, well, I wouldn't say harsh, but very determined government pressure.
But Shanti Kambaram, how heartening do you believe it is that all the MPC members decided to turn down the request from the Finance Ministry to meet? In some sense, was the Finance Ministry wrong in the first place to ask for this meeting? You have an autonomous body that is going to decide on interest rates. You don't have just one man alone. Why are you going to ask for a meeting? Because many people will see this as an attempt to influence.
The way I see it is, the MPC has been constituted for a certain purpose with a certain authority for taking decisions, and they have been outlining their decisions, and as you see that, but for one, they have unanimously voted for this decision. I think yes, from a timing perspective, the Ministry of Finance asking for a meeting at a time just before the monetary policy has possibly raised eyebrows, and that is why you are raising such questions. I think the MPC perhaps was right in declining because there is just a policy in the offing. So the way I look at it is, yes, they asked, the MPC declined, which is right by them because they are just on the verge of a policy. But beyond that, I wouldn't sort of want to speculate. I think their roles are reasonably clear. They're playing out their roles. They need to be an autonomous body. I completely understand the government pressure because they are working on growth. They are working on many fronts. They are doing massive spending, and they are keen to see growth coming back into the economy, and we have seen growth faltering. Mind you, the interest rates, if you see the interest rate trajectory, we have seen transmission of rates even in the last 2 to 3 months if you look at the various rates. But I think the government is keen that this growth agenda gets kicked further. But the way I look at it is, they asked, the MPC declined, which was their right perspective, and so be it. It's good that the institutions are playing out their respective roles. That's all I'd say.
The MPC has decided to assert its autonomy. You know, the MPC was being constantly criticized for having this unanimous view, for having no diversity. So they've done 2 things. A, there is a dissent. So Dr. Dholakia, I think, has given a dissent note, yes. So it's a 5:1 decision. He perhaps wanted rate cuts. The rest of the members voted for status quo. And the other thing is that they told the Finance Ministry in no uncertain terms that if you've appointed us to decide on interest rates, then we're going to do a job independent of your influence. Is that how you read it, and is that heartening indeed?
Well, on the question of unanimity, I think it's the end of the day, there has to be some divergence of opinion among the monetary policy members, and I think this is to my mind, a welcome change, considering that over the last couple of policies, despite data pointing to one direction, the overall MPC was voting in another direction. In fact, Dr. Dholakia, in the last policy, if you read his, in the minutes, if you read his comments, one could clearly see that, he was taking the data into account, and I think this is a healthy, it's a democratic process where all the views have to be taken into account. Unlike the FOMC, where each member has to also provide their own set of forecasts, we don't have that. So I think this is a good start where we can see the divergence of opinion emerging between members, and I think that's a welcome step. On the other issue, I think the government can always send in a written response to the MPC and express its views very clearly. That's, I think, by law, under the new agreement with the RBI, I think the government has, the Ministry of Finance can do that. And I think perhaps it's the timing. And remember, 3 members are nominated by the Ministry of Finance. So I'm sure there is if they want to talk to the Ministry of Finance, there's no such, there's nothing wrong in it. But as Shanti pointed out, perhaps it's because it's just before the policy, there was no discussion. But as I said, there is a process by which the government can express its opinions very clearly. And the Chief Economic Advisor has been fairly vocal about what he thinks about his opinion after the April policy. So I think this is, to me, is not as, to me, the fact that you are now beginning to see some divergence of opinion within the MPC, that is a more exciting proposition or a more exciting development to me than the MPC members not meeting the Minister of Finance.
While Gaurav Kapur insists that, the more exciting thing today is that the MPC did see a dissent. Mr. Dholakia did say that there should be rate cut and there should not be a status quo, and the rest of them voted for a status quo. The question also is that the Finance Ministry is wrong in trying to influence the decision of the MPC, and the timing of the meeting is obviously extremely wrong. But even at any other day, why should the Finance Ministry be meeting MPC members when they have entrusted the MPC to decide on a decision? So in that sense, do you believe it's a good thing, even though 3 of those members have been appointed by the Finance Ministry? Do you believe it's a welcome sign, it's encouraging, it's insightful to actually see these MPC members say no to meeting the government? Or do you actually believe this is the beginning of yet another war path between decisions of interest rate, makers of decisions of interest rates versus the government?
Well, it's difficult to comment on that whole episode without knowing what the letter said, the letter from the Finance Minister. Did he just invite them for a cup of tea? Did the letter say anything about the agenda for the meeting? And if so, what was the agenda laid out? Or was it just a bold statement of invitation asking them to come at a particular time? We just can't judge without knowing what the content of that letter was. That said, I have to say that a meeting convened just before an MPC meeting is perhaps questionable in its timing. But then again, the Finance Ministry has made its opinion known, and the MPC should be sufficiently confident, I would say, the MPC members, of their own independence of spirit, that in principle they could have gone to the meeting and still disagreed with the Finance Minister. I don't know that particular virtue should be assigned to their having declined to attend the meeting. But as I said, we don't know what the letter said.
We don't know what the letter said, and we don't know whether it was wise of them to have turned down the invitation to tea and samosas in North Block. One doesn't know the quality of either the tea or the samosas there. But having said that, I had a question to you on the interest rate action that you said. Given the fact that we've moved to an inflation rate targeting regime, is it not inevitable that the MPC will always have an asymmetric reaction to inflation numbers? Because as you see, in the month of March, when inflation edged up, the RBI quoted that as a reason to hold its hand. But in April, when the rates inched down, the RBI quoted that exactly to say that we don't know whether it's transient. So is it not inevitable that the reaction in an inflation targeting regime will always, by definition almost, be asymmetric?
Not necessarily. The mean of that targeted range, as you know, is 4%. And by their own projections for the next year, the mean works out to 3.34%. Now, if they have confidence in their projections and they have a projected mean for the entire forthcoming year, which is roughly 0.67% below the mean of the targeted range for inflation. To hold the repo rate doesn't make any sense at all. I don't see that there should necessarily be a lack of symmetry in terms of their reaction, but in this case I think it was pretty open and shut. And as I said before, I really think a 100 basis point cut at this point would have been in accordance with their own projections. If they were not confident about their projections, they should have said so right up front and maybe given a much broader range to justify their staying with 6.25. But what I see is a lack of coherence between their inflation projections and their action.
Mr. Ghosh, the point that Ms. Rajaraman is making is a very important point, that the action and what is being said on interest rates, inflation is perhaps not matching. The coherence doesn't seem to be there. Will you agree? Because the policy document very categorically said unusual surprise, the surprise softening, and then of course Veeralacharya in his press conference almost made it out to be that accommodation is inevitable. How do you read those two statements?
See, my simple point is that if you look into the April projection, which Professor Rajaraman just pointed out, the April projection of the RBI was actually 4 to 4.5% in the first half and 4.5 to 5% in the second half. Today, if you look into the forecast, in 2 months, the projection has been cut down significantly to 2 to 4.5% in the first half and 3.5 to 4.5% in the first half. So, a reduction in 200 basis points in the first half and close to 50 basis points in the second half within a span of 2 months makes it a little bit difficult to understand that how is the inflation forecasting exercise actually has been carried out at the central bank, because there has been, if you look into the data for the last 2 to 3 years, there has been a significant overestimation of the inflation numbers actually what came in. One can always justify that in an inflation targeting regime, the central bank needs to keep the inflation target a little higher so as to anchor expectations. But the downside to that argument is that if you are unable to interpret the inflation numbers properly, you actually keep the rates elevated for a longer period of time, and that's exactly what is happening today. If you look into the statement, the central bank has clearly said that the April number, they are still trying to gauge whether the effect will be transitory or permanent. But at the same time, if you look at the risk which they have said, I think there are almost no upside risk apart from one statement which says that the political and financial risks would push up the imported inflation and the allowances under Central Pay Commission recommendation. So, these two are the only two upside risks. Regarding the first, I am not sure whether that's actually a risk as of now, because the oil prices are firmly capped at the downside. So, that may not have an impact on the inflation, and even on the second part, which the central bank actually admits that the pay commission allowances have not been implemented. So, it may not be factored into the data. So, my sense is that yes, if you look into the numbers and the projections in what happened in April, what happened in June, there is a scope for the rates to go down. It may not have been said explicitly in the policy today, because if you just go from a neutral to an accommodative within 2 months, then that may actually unravel the markets and also hurt the credibility of the central bank. So, in my sense, I think the inflation forecasting of the central bank needs to do a little better than what it is currently. Otherwise, it will continue to create an impact of uncertainty in the market expectations.
Indeed. Gaurav Kapur, I'm going to throw that same question to you, because this is a very telling comment that SK Ghosh is making, that the central bank needs to do its inflation targeting in a way that it doesn't leave too much room for speculation. Do you believe what's happening right now is exactly what SK Ghosh and Mythili were alluding to earlier? The inflation targeting is keeping interest rates at an elevated level for a more prolonged period, and perhaps that is leading to speculation in the market, because at the end of the trading day, I think every participant that you spoke to today said the RBI has laid ground for a rate cut in August. I don't know if the RBI has really done that.
Well, actually, I agree with you. I don't think RBI has done that. I think if you notice, they specifically also mentioned that a rate cut, a premature change in policy, at this stage may only question the credibility, because as pointed out in the policy statement and then by Dr. Acharya very clearly, that a rate cut by itself at this stage would not help. One, because there's overhang of liquidity which is really not doing much. Rates have come down sharply. There is enough liquidity in the system. RBI is absorbing close to 4 lakh crores. In fact, through the repo rate, there is close to 1 lakh crore in MSS. Of course, the cost involved comes down if the RBI cuts rates. But I think between August and October, there is definitely, I feel the chances of a cut are more closer to October than August. Yes, by correcting the trajectory, they've taken into account the impact we've seen on inflation, especially core in the last couple of months. And I agree with Dr. Ghosh here that, initially when the April policy presented a trajectory of inflation which showed 4.2% average inflation in Q1 and then 4.7, which averaged out at 4.5, versus what you see now between 2 to 3.5. That's in a way creating an exit route or an escape or preparing the market that, okay, our next step within our neutral stance can be a cut. But in the same policy statement, perhaps to address the expectations of a rate cut building up, the monetary policy statement does also point to the fact that premature change in policy not only may not be that helpful, because investment activity slowdown in private sector is on account of the twin balance sheet problem which needs to be resolved, and a rate cut with the overhang of liquidity which we have right now may not necessarily have a major impact on investment. And secondly, and that's something to me, another interesting thing which they noted is that demonetization impact on growth per se has only been sector specific. It's transient and private consumption is still very resilient.
If I can go across to Keki, Mistry, who's also joining us, there has been a cut in growth estimate and inflation estimate, sir. Does this raise the possibility of a rate cut? I know both SK Ghosh and Gaurav Kapur don't really think so, but what's your take? Indian industry, what is that making of it? No audio.
Well, in the very immediate present, I don't see, and I mentioned that earlier on also, I don't believe there would be a rate cut. In the course of the calendar year, yes, it is possible. There is certain data that RBI will watch and watch carefully. From the domestic front, they will want to watch how the monsoons pan out. That is a huge impact on inflation. On the international front, they will watch what is happening to oil prices, which currently look benign. They will watch what is happening to the US. If you are in a situation where suddenly you start believing that US is going to increase interest rates faster, then in that kind of an environment, India cannot be reducing interest rates, because then that will create a lot of volatility in currencies. That, to my mind, is unlikely, because US is not, again, to my mind, going to increase rates very, very, very sharply. So yes, a 0.25% cut in rates in the course of the year is something which is possible. Could it happen in the next 2 months? I personally doubt. Personally.
But Mr. Mistry, if I may ask you a question on SLR, I mean that has been reduced from 20.5% to 20%. Do you believe there could be more fund flow, credit offtake happen to the more productive assets in the Indian economy?
See, even today banks were carrying excess holding of government securities. So if you look at most of the major banks, my understanding was that they all hold excess government securities. So therefore, by reducing the requirement to hold more government securities, they're already holding more than what is required. So I'm not too sure how much it would sort of lead to any significant change in the liquidity position straight away.
Ghosh, if I may ask you the question on the risk weights and standard asset provision for home loans, is that going to be a big fillip for home loans at all at this stage?
It will reduce the capital requirement for certain categories of loans. So now we have to see loans between, as I said, 30 lakhs and 75 lakhs, and where the loan to value ratio is between 75 and 80%. So it's only in that segment. And the other is, from what I could read of the policy, and the other is for loans above 75 lakhs, where there may be a benefit. So if the loan amount is more than 75 lakhs, and the loan to value ratio is less than 75%, in most cases it is less than 75%, so that that condition gets met, then the risk weight has been lowered from 75 to 50. So it will have some impact on the capital requirement. How much impact it will have will obviously something which will differ from entity to entity, and one would have to sort of recalculate that number. But the reduction in standard asset provisioning is a big positive. But as I said earlier, I wish this was done even on existing loans.
I wish it was done a little early, but let me just get an economist perspective on this. And SK Ghosh, do you expect this particular move to boost demand, at least for the home loan segment?
No, see, I think this is a positive. I think this is a positive move, but my only point is that this should have been also extended to the 30 lakh segment, because that's the segment where the government is trying to push the Prime Minister PMAY Yojana, and that's also corners a significant part of the portfolio of these banks. So, the reduction in risk weights in the 30 to 75 lakhs as well as over 75 lakhs is really a welcome move, but it would have been quite good if that move was also across board, say in the 30 lakh category. So that could have actually released more of capital than what could have been expected. But I think that this is a positive move, and hopefully this will spark some amount of demand into the market.
Okay, some kind of demand in the market. I've got 2 quick last minutes to go, and so I'm going to take quick closing comments from each one of you. And SK Ghosh, let me begin with you. At this stage, what is it that the markets and stakeholders like yourselves and me need to anticipate from the RBI come the August 1st and 2nd policy?
See, as far as the August policy is concerned, after today's policy statement, I think there will be 2 prints of data. So one will be the inflation numbers which will be released for the month of May on June 12th, and other will be the June numbers. Well, the first inflation number could be actually closer to 2%. The second reading, if everything goes all right, will be sub 2%. So already there will be 2 inflation readings which will be significantly benign in the next 2 months. So that could actually pave the way for some amount of easing in the August policy. If the RBI doesn't go ahead with the August policy, or it decides to go ahead in October, then it could have another 2 numbers, which again would be under significantly on the benign side. So if the inflation trajectory moves the way it has been moving, I think there is ample possibility of a rate cut, possibly as early as in August.
Indira, Rajaraman, given the commentary today, given the fact that there is an acknowledgement and admission that inflation will be lower, and even though interest rates will perhaps be at an elevated level for a long while, what is it? I'm not asking you to project or speculate here, but what kind of policy trajectory are we looking at this stage? And what is the specific action that you expect the RBI to make in August?
I certainly expect that in the forthcoming policies there has to be some recognition of the lower inflation platform that we are on, and I would be extremely disappointed if this information were not acted upon, and if interest rates, if the repo rate were not reduced. Let me also quickly add that some commentators have said that there is ample liquidity, and that therefore repo rate cut would not have mattered. If that were the case, we shouldn't be watching the repo rate at all. One of the reasons why liquidity offtake has been poor has been because rates have been elevated. So I do believe a rate cut is essential, and I hope it comes sooner rather than later.
All right, a rate cut is essential, and it hopefully will come sooner than later. A quick closing comment from Keki, Mistry, sir, and the MPC. I've had a discussion on this when you were not a part of this show, but I've had a discussion on this with various stakeholders. The fact that the MPC denied a meeting with the Finance Ministry, do you see this as a positive move, something that reinforces confidence in the autonomy and independence of the RBI?
Well, to my mind, the confidence in the independence of RBI was always there. It got strengthened a couple of policies ago when everybody expected interest rates to be dropped. Not even couple, maybe 3 policies back. I think it was in December. When everybody expected interest rates to be dropped, and interest rates were not dropped because the RBI believed that at that time it would be more appropriate to hold on to rates rather than lower rates. So I think that independence of the central bank, the independence of the committee has been fully sort of reinforced over time.
Okay, fully reinforced as far as the independence of the RBI and autonomy is concerned. But on that note, SK Ghosh, Indira, Rajaraman, Keki, Mistry and everybody else who's been a part of this very special show, thank you very, very much for being with us. Viewers, thank you very much for tuning in. Keep it with ET Now. News, updates, views and analysis following.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.